Hi guys, welcome back to another video. So today I'll be looking into Lululemon, which presented a very interesting case where even though the management give very good insights regarding next quarters, the share price still crashes by 12% on the day after its reported earnings. So there are many reasons, and one of the reasons can be seen from the balance sheet, and this also presents another factor that investors might not be so optimistic as compared to the management. So we'll see into the different aspects and reasons why the share price are dropping so much. So a brief introduction of why Lululemon is such an important company to focus on as well as other companies. So Lululemon can be considered a luxury or high-class sports brand that is very popular, especially among women, for sports and yoga wears. So the company actually sets the tone or example of whether consumers of middle to higher class is slowing down in spending or not, because their products are much more expensive as compared to Nike or Adidas. Moreover, they have historically been a good company where the products are always still in demand even though the other companies are struggling to sell. So if we look at the share price of Lululemon, it collapsed 12.85% even though it beat the revenue and the profit expectation. However, looking at the guidance, it was a bit softer, but it was still hitting the targets, which makes it very interesting into why the stocks was being punished. And I will later show you the main reason that a lot of investors might have looked into and were worried about. Moreover, Lululemon has even raised the full year forecast by increasing both the revenue and the adjusted earnings per share from 7.8 million of the higher limit to 7.94 billion, whereas for the earnings per share from $9.75 or $9.90 of the higher limit to $9.97. So it's very weird that even by raising all this full year guidance, the share price still crashed by itself. So for Lululemon, it's always priced higher compared to the rest of the sports brand. As you can see from the PE ratio, Lululemon was at a PE ratio of 31, followed by Nike, which was 31, and Adidas at 16. However, Lululemon has always been able to sell their products at normal prices as compared to Adidas and Nike. This can be seen from the profit margin comparison between Nike and Lululemon. As you can see from this macro trends chart, Lululemon, which represents the dotted line, whereas for Nike it represents the blue line. So throughout the past few years, Lululemon has constantly been able to keep at a good profit margin for gross margin over at least 50%, whereas for Nike it's always below 40 and occasionally drops as well. Moreover, the interesting thing that every investor have to take note is that companies like Nike has actually already warned of margin hit to clear inventory, but Lululemon is actually doing a different thing, as the management is instead ramping up inventory to meet the demand for the year-end season, which is one of the reasons why the investors are selling the stocks if they are just looking at the balance sheet, as the inventory has skyrocketed, which I will show you later on. So let's take a quick look into their balance sheet. As you can see from these filings, for Lululemon, the revenue came in at 1.56 million, whereas if you compare to the last quarter of the revenue, it was a bit higher of 1.868 million. So there was a slight drop in the revenue, but that is not the highlight or a big concern, honestly, because it was a normal routine season. And you can see from the gross profit, it's at a very amazing high gross profit of 55.9%, even with a so-called slowdown in demand, if there is. So the interesting thing is that for the next quarter, it's expected to be at 2.605 million, and the management has a history of giving a very conservative estimate. So why is it this high? It's because there are a lot of events. As you know, there is 11/11, 11/11, and 12/12, plus Black Friday and Christmas Eve and Thanksgivings, and a lot of other events, etc. So because of all these seasons or gifting seasons, people might actually buy a lot of products, and you can hear later from the management that they are getting a lot of orders and they are expecting much more to come. So looking into their current assets and inventories, as you can see, the current assets actually is the cash they are holding is much lower compared to the first quarter, as it drops by around 800 million. Whereas compared to the inventories skyrocketed up to 1,741 million as compared to 966 million. So because of this, some investors might be a bit concerned of the demand, like similar to semicon industries. However, this might be different if you believe in what the management is actually saying about. So I will show you later on what they talk about. However, let's keep focus on the balance sheet first. So if you see from the current liabilities is only at a value of 1,322 million, and it's not a very big concern as long as they can sell off this inventory to pay off for the liabilities. So liabilities wise, it's very cheap or very low, and it has a very good assets to cover them. So in liabilities wise, Lululemon has no issue. So for the cash flow is where we can see how the company spends the money and the reason why their cash flow drops by so much. As you can see from the net increase or decrease in the cash and cash equivalent for this quarter, it's actually decreased by 907 million. So what is the reason why? It's because, as you can see, the inventories here spend is much higher compared to last year of 288 million as compared to 832 million. And you can see that the good thing is that the net income actually increased as compared to last year. So it's not because that they are losing business that's result in the decrease in cash flow, but more of because of the inventory spend. Moreover, they have also purchased properties and equipment to improve their facilities, and also constantly do repurchase of common stock, which is a good thing for shareholders. So looking at the details of the balance sheet and cash flow, there is a lot of uncertainty or questions to be asked. So let's take a look at a video from CNBC where they interviewed the CEO regarding the demands and the inventory. So this video is very important as it is one of the aspects for you to understand when you are investing in a company. Moreover, reading earnings call transcripts is also important as well. So let's take a look first before we proceed.
Mr. McDonald, it's David Faber. In the near term, particularly in this holiday season, I'm just curious to get your senses to the consumer. Are they as strong as they have been? Are you a bit concerned, perhaps, that there is starting to, be some weakness that's being shown?
Morning, David. We haven't seen any weakness with our consumer. We're well aware of the macro environment. We're well aware that many other retailers in the malls are heavily discounting. We have not. We don't see a need to. Regular price is driving our business. And as we look forward, what I would just call out versus last year, where we saw a lot of gift giving pulled forward into the quarter, it really started to just tick up over the Thanksgiving weekend. So that would suggest there's a lot of gift giving still to come, and that's what we're tracking and looking for. But on a quarter-to-date basis, our guest metrics remain very healthy, and I shared the Q3 ones, and there's no change in that behavior. But it is the gift giving in this quarter that's critical, and behavior is pushing it. It appears to be closer to the holiday than last year when the headlines were shop early.
Calvin, some on the street point out that Lulu has a history of guiding pretty conservatively in December and then raising in January. Any reason to think that pattern might be broken?
We're pleased where we're at from a quarter to date perspective, and feel the guidance of 23 to 24% under the circumstances of some of the topics we discussed is the appropriate and right guidance at this point. And the teams are ready and focused, and we have the product. And what we've seen through the Thanksgiving weekend is the product continues to resonate. We're acquiring new guests as well as our existing guests engaging with us. So we're excited about the holiday season, but there's some critical weeks still ahead for us.
Yeah, and I know Jim asked you a bit about this, but some of the analysts being concerned about what they called higher inventory than they might have expected, and your CFO obviously defending that. Can you give our viewers a sense as to why they should not be concerned about obviously what was a growing inventory level at the company at this point?
No, for sure. Inventory came into where we guided, and we did say Q3 would be the high point of our inventory numbers. It's a combination of where our manufacturer partners were and their ability to fulfill our orders, a combination of managing ocean and air and trying to get ahead of that balance and costs on shipping. And on a 3-year CAGR, it's up 38% on a unit basis on a growth of 27%. So we're definitely sitting we are sitting above our growth number, but with almost half of that inventory being core non-seasonal inventory. Those investments, we believe, have helped fuel our demand. We're selling at full price, and we're well positioned for the holiday heading into Q1, and we will start to now be able to work those inventory numbers down. But we don't see and haven't called out any concern or risk.
So let's dive into more details with their recent earnings call. As you can see from the inventory, they have ended the quarter 3 with dollar inventory up 85% on a 1-year basis and units up 38% on a 3-year CAGR basis. So this is met with their in-line expectations. So actually, the rise in inventory was already planned by the management because last year the inventory was too lean to meet the demand. Moreover, they have constantly mentioned that the demand has been skyrocketing, and during the season of giving and Thanksgiving week and holiday seasons, including the Black Friday, was their biggest day ever in their history in terms of revenue and traffic driven. So this is actually a very good thing. And however, one thing important to take note is that although they are very optimistic, as an investor, you have to believe in their words, because in the event if the next quarter results comes in disappointing, there might be a risk that the share price might drop further. The last thing that I would like to mention is that they have constantly said that their products are being sold at a regular price and are still able to sell even though they are selling for a higher price, because regular price compared to sales price is much higher as compared to Nike and Adidas that have constantly been cutting their products price in order to cut inventory. If you can go and take a notice that stores of Lululemon is constantly expensive, whereas compared to Nike and Adidas, they are always constantly sales as well. So because of this, I am sort of siding with the management in terms of the demand. However, please do more diligence and take note of the risk involved when it comes to investing in companies like this. Through this slide analysis, I hope that it amplifies the importance of reading both the balance sheet and understanding from the management perspective through the earnings call. This is not a financial advice, and I hope that you could go and do more research and please take note of the risk involved when it comes to investing in companies, especially in the US. If you have stayed till the end, thank you so much for the support, and I really appreciate it if you could give a like, subscribe, and comment on how I can further improve on the videos to make it either more entertaining or more informative. And I'll see you in the next video.